We're going to introduce Christy Calderwood, the CFO of HL Flake, to get into the details a little bit of the 2021 market. Hey, Christy, how you doing today?
Good, Sean. How are you doing?
I'm great. So, obviously 2020 was a bit of a wild year.
Yes.
To say the least. 2021 is definitely shaping up to be a bit better. So I'm pretty excited for that. But getting down into the numbers a bit more, how are you feeling about 2021?
Very optimistic, actually. And Mrinalini is going to, our product expert here, is going to help us really focus in on that in just a second. But me personally, I'm seeing just that upward tick that we were really expecting to see in 2021. When we started planning, we thought it would be a slow, gradual, just increase. And that's what we're seeing, especially in the residential and commercial markets. So we're very excited about that. What about yourself?
Oh, that's great. I mean, certainly Q4 2020 looked good, but then January and February 2021, not so good. But I'm happy to say that March really seemed to take off. It seems to be with vaccination speeding up and things opening up and the weather changing and people just feeling better. Yes. It seems like people are out there kind of spending money. So things are definitely looking up.
That they are.
You want to tell us about your guests a little bit?
I do. Today, we are really excited to partner with Allegion to provide a market outlook. We have brought in one of their competitive intelligence experts. Her name is Mrinalini, and she helps provide insight on really just the market, the channel, and all the trends there. And she translates those into business opportunities and threats. She typically does that for the Allegion team, but today she's going to do it for us and our customers. So without further ado, the floor is yours, Mrinalini.
Thank you so much, Christy. And hello, everyone, and good afternoon from Indianapolis. So like Christy mentioned, I will be walking you guys through the market outlook and helping you figure out what to expect in 2021 and beyond. We'll start off by giving you an overall view of the economy in general, the macroeconomy. We'll talk a little bit about the residential markets, switch gears to our non-residential markets, and then finally wrap it up with the non-residential aftermarket. So with that, we'll just go ahead and get started. So, the chart what you see here on the screen at the top, the chart that you're looking at gives you an overview of the US GDP. So this is an overall view of the market. The area in gray is obviously historical GDP, and then we're looking at the overall GDP growth. On the right-hand side, you're seeing a lot of key indicators. If it's in green, it means that it's moving in the direction we want it to. And if it's in red, not so much. It's not moving in a direction we want it to. So overall, if you look at the overall US economy, the economy is expected to recover. We're already seeing that recovery. And then if you're looking, if you look at the overall GDP growth rate, it's 4.3%. Unemployment is going down. So things are looking good for the overall US economy. When this forecast was, taken into account, we didn't take into account the stimulus package that has just been passed. It also does not include the infrastructure bill that's being discussed. So those are upside risks to the forecast. One thing I will talk about is, inflation is going up. You guys might have seen some of it, and we'll see some of that continue. And then the last thing, as we talk about it, if you look at this chart, overall the economy did poorly last year, of course. It's an understatement. But compared to the last Great Recession, things are not as bad, and we're already on our path to recovery. If you peel that onion back a layer, right? If you look at the overall economy, things are on the way to recover, on its way to recover. But what we see here is like a K-shaped recovery. So while the last recession we all experienced that pain almost equally, this recession has created winners and losers. So it's created the haves or the have-nots. So when we're talking about people who the haves are the people who are who own a home, who are working in an industry that's actually doing really well, who are in good health. So if you're working in e-commerce, home improvement, the housing industry, you're doing really well. And the have-nots, on the other hand, are the people who are, the essential workers, or you are poor, poor health, or you're working in an industry that's not doing as well. So the service industry, tourism. So the story, your story of recovery has been really different versus the people who, own homes and are in a different industry. So that's kind of why, you'll see that bifurcation, if you will, where one set of the economy, one set of people are experiencing something very different from the other set. And in the long term, we'll see that this will increase that wealth gap, but this kind of reconciles, right? Overall, on the top level, things are good, things are looking good. You peel the onion back a layer, and that's where you see how people are experiencing this recession a little differently, and also the recovery is a little different. Looking at the overall view of what to expect, this comes from the Congressional Budget Office. So the 10 years out, what we can expect of the overall economy is, on the chart on the left talks about the overall GDP growth rate, and on the right, we're talking about unemployment. 2021 is expected to be really strong, positive. We expect 2022 to be the same way. And in the long run, we expect the US GDP to grow about 2%. With unemployment, though, of course, 2021, you expect unemployment to improve and that trend to continue. In the long run, though, we expect unemployment to be about 4%. And the key takeaway here is that it is not expected to go back to those pre-pandemic levels. So we did lose a little bit in that recession. So even though you're seeing a lot of that recovery, we did lose a little bit over here. Switching gears to, we talked about this earlier. One of the things that we're seeing, and you guys may have already started experiencing, is inflation. The main reason for this is you see the US GDP recovering. We talked about that. At that same time, the Chinese economy has already improved. It's on its path to recovery. India's GDP is coming back, and so is the GDP of the Eurozone. So we are in a situation where you have a global recovery at the same time, right? The whole world is on its path to recovery, and that's putting immense demand pressure on commodities and raw materials. So you will continue to see that. Overall things are going well, but inflation will be that dark cloud, if you will, which will continue to, we do not expect this to let up anytime soon. So we'll continue to see that inflation pressure even going forward. So if I have to sum up the overall, what can we expect for the US economy? Things are going well. Stimulus and the infrastructure bills are upside risks. And of course, infrastructure is a dark spot, if you will. And now I want to walk you guys through what's happening in the residential markets. Most of you are probably experiencing this. One of the reasons why we look at the residential markets, of course, is the single family residential market leads the overall economy. So if anything, if anything goes wrong with the single family residential market, the US economy will do poorly. And what we're seeing here is the US residential market, especially the single family market, is doing really, really, really well. So the charts on the top are starts for both single family and multifamily. When we're talking about starts, what it essentially means is that the project has broken ground. So they've started building the house or the multifamily apartments, but it has not been completed. So this is a leading indicator. So they are expected to go, they are expected to grow really, really strongly, especially in the single family market. If you look at some of the indicators on the right, same thing, same logic. Red is good. Red is bad, green is good. The only exception I would call out to that is the pending sales index. What this index shows you is how many homes are under contract. So it's a good gauge of demand. And what it's showing you, it's down significantly this month, and that is a reflection of inventory or supply. And that's the one thing, so we've got so much demand for single family homes and not enough homes. What that does is it improves, it increases home prices, which is good for your home equity, bad for affordability. For people wanting to get into the market. So that lack of inventory is what's driving a lot of the starts up. Multifamily is a slightly different story with, with this particular industry. The multifamily market has seen a lot of building in the last few years. And so we're seeing a little bit of that slowdown. And also with the pandemic and people being stuck at home for long periods of time, and with the urban core become, as you work from home, it's not as essential to be in that urban core. So we're seeing that decline in multifamily. Some of it is simply, a reflection of it going back to normal, and the pandemic actually just made that problem a lot worse. So the residential market overall really red hot because, single family is the one that's driving a lot of that demand, and then multifamily is, fairly lukewarm to weak. This kind of gives you an overview of this kind of gives you a quick overview of the inventory problem that we talked about. Single family, the inventories are trending really, really low. So right now, single family inventory is at the months of supply, meaning is at 2 months. So what this means is we've got inventory that will last in this market for about 2 months. So and in a normal market, you would have about 6 to 8 months of inventory available. So that's a continuing problem in this particular industry. And it's down 36% from last year. And last year, this particular number was at 3.1, which is also really low. So again, that inventory problem continues. And again, whenever that's, the inventories here is in that gray line and it's inverted, which is why you see that inventory going down. It's going up. It's actually going down, but because we've inverted, it looks as though it's going up. And so that's typically when inventories are going down, then starts to tend to catch up. So we've got to keep an eye on this. Inventories will catch up, but that's if anything, that's the piece that's dragging the market down, if you will. And then multifamilies, right? We talked about this. This is underperforming the overall market. And as people move away from that urban core, because you no longer need to be in the urban core as you work from home.
Don't think she's going to do all of them.
So the next piece, and so to wrap up, single family doing really well, multifamily not so much, but overall our residential markets are really, really strong. Taking a look at our non-residential markets. In the non-residential markets, we talked about how the single-family residential markets lead the overall economy. The non-residential markets lag the overall economy. So we talked about how the overall economy is really strong, single family is doing really well. And in the non-residential markets, because these markets lag the overall economy, that recovery that we see in the market is not apparent in these markets yet. So you will not, so non-residential markets, we're still in that process, we're still in that period of slower growth. So overall for non-residential markets, 2021 is not going to be a great year. 2022 is when you'll see a little bit of that recovery in our non-residential markets. Some of the key indicators here, however, so again, when you look at our non-residential markets, we're looking at, some key verticals like healthcare, education, and office. And on the right, you have those key indicators. Again, green means good. And what you'll notice is a lot of these indicators are doing well. They're in the green, meaning they're on these leading indicators are moving in the right direction, which means that growth is coming. The overall economy is improving, so the growth is coming. We're just not going to see it yet in our key markets this year yet. So whether it's our institutional markets, where you'll see, healthcare has been impacted by that decline in elective surgeries. However, those revenues are, on the uptick. Same thing with the education market, where classes, whether it's higher ed and online classes or even K to 12 with virtual learning, it's kind of slowed down investments or new construction in this space. And then we'll talk about how that impacts the aftermarket in a little bit. When it comes to the commercial new construction, this is really that space. When we talked about that haves and the have-nots, the hospitality industry, retail, all of this falls under the commercial space. And of course, they're all kind of really, really poorly impacted by the pandemic and the social distancing measures that we have in place. The one bright spot in the commercial markets are the warehouses, which are growing really well thanks to the e-commerce growth. So if you're in that space, that'll continue to be good. But overall, institutional markets are not doing, both the institutional and commercial markets are not going to do well in 2021. Commercial markets are expected to perform a lot worse than the institutional markets. And then 2022 is when you'll see that recovery. If you look at the next charts, this presents the views of 8 different economists on what to expect in 2021. So the chart in green at the top is the overall non-residential market. And if you'll notice, all the charts are inverted. So the different economists have different points of views on when they expect or how much do they expect the market to decline, but they all agree that the market is expected to decline in 2021. So the consensus forecast down 6% for non-residential markets in 2021. The charts at the bottom, you've got the institutional markets in orange and the commercial markets in blue. Again, strong negative growth, if you will. The commercial markets are expected to be a lot worse than the institutional markets. And there are a few points of views within the institutional markets where they expect, some of the economists expect the institutional markets to be slightly better, but overall still down 4% and commercial markets down 7%. If you look at the 2022 markets, this is when you'll see that recovery building a little bit, if you will. Still up 3%, so not robust growth, not anything, Moody's here is the exception with that 16% growth rate for the non-residential markets. But overall, we expect a recovery in those markets. So 2 to 3% is what we would expect, and that consensus forecast is about 3%. For our institutional markets, almost all of the economists expect the institutional markets to recover pretty strongly. So the institutional markets are expected to be up 3%. And our commercial markets, we've got a lot of variation here and different opinions. So it's going to be more of a mixed bag. But if you're looking at the consensus, again, up about 3%. So that's the view for our non-residential markets. So if I have to sum it up, 2021 is not going to be a great year. 2022 is when you'll see that growth. So, something to keep in mind. And of course, our institutional markets are going to be a little more robust than our commercial markets. So looking at this chart here talks about the non-residential aftermarkets. So the way we define it is both break fix as well as the big renovation projects. So the chart on the left talks about what to expect for the aftermarket growth rates. So this is kind of forward looking. So if you'll notice, 2021 for the most part is still in that negative territory. And then the second quarter onwards is when that recovery begins. So somewhere in the middle of the year is when you'll see that upward trend in the commercial aftermarket. And then slowly that is expected to pick up, where by the end of 2021, we're definitely in that growth territory with the growth peaking around the second quarter of next year. But we'll see that recovery in this year itself. So that's a positive trend, if you will, for the commercial aftermarket. On the right-hand side, the chart on the right-hand side of the bar graph kind of talks about renovation trends. And these are the large-scale renovation trends. The individual graphs or the individual bars represent the amount spent on renovation. So for instance, in 2010, we spent 49 billion on renovation. In 2020, that was about 69. And then that percentage denoted by the line graph is renovation as a percentage of overall construction, new construction. So typically when new construction goes down, you do see renovation go up. So you saw that in the last recession where 2020, construction went down, renovation went down accordingly, but as a percentage of new construction, it was a pretty decent number at 26%. So while we've seen that uptick, we do see new construction renovation increase in 20 to 21%. It's not a huge increase. But it is higher than what we saw in the last 2 years. One of the few things, it is slightly different across different verticals. So surprisingly, or no surprises here, in the hospitality industry, you did see this take up a lot more than you would expect. So, there are industries where people are just taking advantage of the fact that the building does not have as many people, and they're taking advantage of that and renovating. And in general, and of course, you saw a similar trend in education, especially higher ed. But in general, what we can expect looking forward, going forward is, healthcare does need more retrofit opportunities. We saw that in this pandemic, the healthcare facilities were not as prepared. So they are going to invest so they are prepared for the next pandemic. Better ways to introduce security, control the flow of people, track the movement of people, and of course, investments in touchless entry, whether it's in the healthcare. We were also seeing a lot of that in the higher ed space. And then what we saw also is that deferred maintenance component. We expect, oh my God, I'm so sorry. I didn't realize I hadn't clicked this forward. What we also see is that deferred maintenance component. So we expect that to come back up. And just quickly summarizing, if you look at the aftermarket, that recovery in late 2021, and then 2022 is when it peaks. And then if you look at those renovation trends in the last recession, you saw that the renovation percentage was pretty high. We haven't really seen that this recession. It's increased, but not as much. So you'll continue to see that with this particular, you'll see investments, and you'll also see those deferred maintenance projects come back online. And so that recovery is going to build in the later part of the year, peaking in next mid-2021. So that kind of, concludes the prepared remarks. We've covered, what to expect in the overall economy, how the residential market's different from the non-residential markets, and also the aftermarket, which is non-residential aftermarket, which is slightly different and from our non-residential new construction markets. So with that, I'll turn it back to you, Christy.
Thank you very much. I do appreciate that. That was a lot of information to unpack in a short amount of time. So for those that you maybe joined in the middle of the presentation, or those that just needs it summed up into some key, pun intended, some key points, what would you suggest?
Alrighty. So if you remember nothing else, right? The 2021 is a good year for our economy overall. Residential markets are doing great. Non-residential markets, you'll expect, this is not going to be a great year, but expect to ramp up next year. So come 2022 is when you'll see that ramp up. And then those aftermarket opportunities, especially in healthcare and then hospitality, where they can afford it, they're still spending the money to renovate the properties. And healthcare just needs to be better prepared for the next pandemic. So those would be some bright spots in the economy, if you will.
Awesome. Thank you so much for your time and sharing your expertise with all of our customers. We really appreciate it.
Thank you.
Have a good day.
You too. Bye-bye.
Thanks.